When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals for smart investing and careful planning. On today's show, we're going to be talking about should world events change your retirement plans. We'll also answer listener questions and then the number one mistake that causes people to unretire. My name's Jeff Shea. As always, I'm just here to ask the questions. But the words of wisdom and solid advice, they come from the other Jeff in this radio program. It's Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
Doing great. Always fun to be with you and the listeners. And I don't know, just get a lot of things off my chest. You know, there's lots of stuff going on right now.
Well, we're going to talk about it all on today's radio program. Before we get started, remind people the phone number 520-780-9059. It's 520-780-9059. That is the number that you'll use if you'd like to come in and sit down with Jeff on a one-on-one basis and have a conversation about your journey towards a confident retirement. Again, it is the Retirement Roadmap, absolutely no cost and no obligation. Jeff, every time we turn on the news right now, it's global conflict, inflation concerns, interest rates. A lot of people nearing retirement are asking a very simple question. Should what's happening in the world affect whether or not I should retire? What do you think?
I certainly think that it creates more uncertainty, and uncertainty creates angst and anxiety and frustrations and maybe stress. And so if you've got a paycheck and it alleviates that stress, you can kind of ride those investments out and ride these economic situations out. Maybe it's good to work a little bit longer and not think about, oh, I have to retire by this time, unless you're forced to. Maybe it's an age situation because you're a pilot or your business is selling out and you've got a new boss and your situation isn't going to remain any longer, or the downsizing, or government changes up a program that you work with, or your contract's over. Sometimes you're forced to retire. The thing is if you have a plan, all plans should already be, take into consideration the uncertainties. And that's the whole reason we plan, is because there's a lot of obstacles out there in the trip through retirement. I kind of have an analogy where you're getting on the retirement boat and you're going out into uncharted waters. You've never been out there before. It's probably good to have a skipper that's sailed them before. We're that skipper. I mean, we've been doing it for years and we know what those obstacles are. So if you have a plan, whether it's a flight plan because you're flying a plane through retirement, or whether you're driving a boat, you've still got to have a travel plan. And that travel plan is to accommodate for those uncertainties and the storms that might come, and to make sure that you have, umbrella for when it rains and a raincoat and some other things that keep you dry through the weather, or that you have a plan for the uncertainty. I mean, the only thing that's certain about life is it's uncertain, right? There's always change. The only thing that's consistent is change. And we've heard all those sayings. And the thing is when we get kind of complacent in this work mode into planning for retirement mode, just by working and saving and doing the 401k, and you see your assets grow and grow and grow, even though I think the market, and I've said this several times, is overvalued. We're still making money in it, but there's no guarantee that it's going to continue. And a lot of people have been in a position to take advantage of this and feel real complacent and real confident that they can retire and nothing bad's going to happen, because it hasn't for a while. The fact is it could at any time. And if we're at a high point in the market and the market crumbles and you lose half your assets, you might be a little bit nervous and might not be able to get that job back. You might not be able to unretire, even if you want to. And nobody really wants to unretire. Once you get on that boat and you're sailing off into the sunset, you want to stay on the ride, don't you? I mean, I want to make sure that we keep people happy that's on the boat of retirement, off into retirement bliss, whatever. I want to make sure that people aren't nervous. And that's really what I think one of the biggest advantages of dealing with an advisor that looks at a holistic approach, looks at not just, hey, stocks and bonds and don't worry over the long haul, they all make good money. Well, that's true. And over the long haul, you've already had that long haul, 30 or 40 years of working, and you should have been investing in the market and those things that are risky and volatile, because they give the biggest returns if you're looking at a 30 or 40 year long-term holding pattern or investing pattern or systematic investment pattern. When you get to that systematic income pattern, which is a withdrawal program, then you have to preserve those assets. It's a totally different strategy, and math will prove that right. Wall Street will tell you that I'm a fool for saying it, because over the long haul, well, the long haul when you're taking income is a very short haul, because you're taking money out every month or every week or every quarter, every year, whatever. You're depleting those assets and you can't handle downturns in the market. And if you look at what volatility does over a few decades, it will erode your investments faster than anything, especially when you're using them. So I think people that kind of, whether it's really in the front of mind or top of mind, or if it's just kind of the back of their mind, I think they know that. And I think most people, even wealthy people that I meet with that have millions and tens of millions of dollars, would still seem to be worried about running out of money and worried about the bad things that can happen. And some of them have never been given opportunities to protect their life's work and set some aside, at least enough of the profits or enough of the gains, so they don't have to worry about navigating the waters of retirement, finding out where the obstacles are the first time, because they don't know where they are until they hit them or until the boat sinks, and then they are in a world of trouble. Yeah, world events and all the uncertainty right now makes retiring right now hard, unless you have a plan. If you have a plan and you've already had a plan, I have people that are coming in actually just in the last few days and this coming week that are retiring right now, and they've already planned to retire. We've been working out this program for 7 years, and it doesn't matter if there's a war in Iraq. It doesn't matter if there's inflation. I mean, all those things matter, but it's not going to derail their plan. It doesn't matter if the market corrects 20% next week, because we've already got an income plan set up that's going to guarantee them replacement income for their paycheck, so they don't have to worry, so that they can still be long haul investors when it comes to the money in the market. They don't have to be always trying to time the market and never take money out when it goes down and so forth, because they've got assets that they can withdraw from that don't have volatility associated with them, or that add guaranteed income, which securities, which interesting, they use the word security for anything that has risk. That's a Wall Street term for risky stuff. So securities business is not really secure when it comes to retirement and it comes to income. So I don't know if I answer that whole question. Bottom line is everything's easier with a plan, and nothing is easy without a plan, especially when things are as uncertain as we've seen them between legislation, between how opposed politics have gotten between each other. Just trying to make the other side look bad at the expense of the American people doesn't bode well for any plan, retirement, financial, or for anybody, let alone retirees. But this war situation, whether it's justified or not, I hope that the reason that we went in and bombed Iran was because there really wasn't an imminent threat. I assume our government has some intel that they would make wise and smart decisions. I think Trump is an anti-war person in general, but may have been coaxed in by Israel and some of the Middle Eastern allies that there was more imminent danger maybe to them than us, but nevertheless, we got into it. So we've got a situation that's going to make energy prices go up. It's going to make inflation probably come back. It's not a situation that I think Trump wants as president to be on his watch. So I hope he had a good reason. And I hope our leadership can get us through it differently than all the last times, because it doesn't seem like anything that involves the Middle East is ever short term, and it doesn't ever seem different. They're the same words in the stock market that are like the worst, scariest 4 words in the market are, oh, it's different this time. Well, I think it's the same thing when we go to battle and try to fight what I would say religious wars, or wars with maybe irrational convictions on one side or the other, tend to last a long time, are protracted and dangerous and costly, not just in resources and assets, but potentially life. We've already seen that. So all those things kind of make my stomach hurt. They all make my brain turn a little faster, trying to think of what do we do? Where do we go? But when it comes down to finances, is protect your assets. And for those assets that you're willing to risk, you follow the money. And we've been able to do that and beat the market consistently. But it doesn't come down to timing. It just comes down to logic and reason. It doesn't come down to, oh, just buy and hold, park it in there. And if the market goes up, the market goes down. Don't worry, over the long haul, it'll be higher. Well, we only want to be in the market with our risk stuff when it's going up, not down. And if it starts going down, we're not going to be in it. We're very attuned to what's going on in the market right now. And we're very in tune with the idea that the markets in general are down. Nevertheless, there are sectors of the market that have to do with energy and this war that are going to be strengthened because of it. We've seen gold and silver sell off. Okay, we don't have to take positions of that anymore. We can wait till it starts going up again. I mean, there's ways to navigate all these uncertainties based on the news and based on what's going on with different asset classes. But you have to be nimble. That's one of the advantages that I think, probably the biggest advantage of dealing with an independent, smaller organization. I mean, we don't manage tens of trillions of dollars like Merrill Lynch and Fidelity and Vanguard, who can't do anything with your money other than park and hold it. They can't trade it every day. I mean, every time they get a new paycheck from a 401k, they just reinvest in the same stuff and keep trying to push the market up by the increased volumes that they can take in from revenues and buy their funds up. But if the market crashes, it becomes a big sell-off, their funds are going to go down. They can't get out of the market. They can't protect what you have. And that's a little bit different. They also don't use annuities for guaranteed income. They don't use LRRPs for life insurance programs that give you tax-free income and give you some protection and downside protection with principal protection and indexing that makes money when the market makes money, but doesn't lose money when the market loses money. That's not a Wall Street thing. And so some people think, well, you're kind of small. Gee, I'd rather deal with Merrill Lynch or some bigger company. A bigger company that really can't do much for you except one thing, and that's the same thing they do for everybody. I've never seen proprietary type investment strategies at any of them. It's just park and hold and how much risk do you want? And we'll just see what the market does and hang in there. It'll come back. And it's the same old story. You're very limited to what resources they can provide. And it's basically just being a number in a big fat portfolio that you have no control over. I would just keep naming it, Merrill Lynch and Schwab and all those guys. They manage too much money to treat you separately or individually. And that's why I think people leave those firms day in and day out and come to firms like us. But it is a question that people ask, why are you different? Why shouldn't I just go to Merrill Lynch? They're bigger. They've been around longer. They're bigger and they've been around longer. And they basically are an inventory wholesaler of stocks and bonds. And you're their pawn in their model. It's their model. It's their profit they're after, not yours. And if you get along for the ride and over the long term make some money, then they think they're doing their job, but all the while that they're nickel and diamond profits off the top and basically skimming the cream off the top for their own benefit. So you ask a simple question. I gave you a big, long answer. I do that every time. I know that. I think we went down the road probably to a few more questions that you're going to ask. But bottom line is, yeah, things are uncertain. How do you navigate it? Well, you navigate it by being watchful, by being nimble, by being experienced, by knowing where the obstacles are, and by kind of premeditation. Basically, it's planning. It's pre-event, is setting yourself up so that when these storms hit, you're already okay. There was an analogy, just one last analogy, is I actually heard it at church. There was a farmer that was hiring a new ranch hand, and he says, why should I hire you? And the guy says, I can sleep when the wind blows. And he goes like, okay. And the other reason, well, I can sleep when the rain comes, and I can sleep even during the worst storm. And he's like, whatever. Well, I don't have much choice. Well, we'll give you a shot. And he hired him. The guy was a good worker. And one night there was this crazy storm come in, and he was worried about his cattle running off and losing his horses and wrecking the wagons and the stuff that typically was left out. And he got up and he looks for his assistant and says like, where is he? Where is he? And he finds him. He's not outside. He's still in his bed. And he goes like, what are you doing, man? There's a storm out here. We need to go get everything set up. And he goes, I already did it. That's what I did. I prepared for this. And that's when the guy said, oh, I get it. You can sleep when the wind blows because you prepare, because you're actually forward thinking instead of backward thinking or reactionary, which most of us, I guess, typically are. We like to react to our situations rather than prepare for them or to plan for them and to be prepared. I'm sure this guy was a good Boy Scout. Be prepared. And he was prepared for when the wind blows and when the storms come. We have to be prepared in our financial plans as well, just the same. Because I want to sleep when the wind blows. I want you to sleep when the wind blows and the storm comes. And the only way you can do it is with a plan.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. And we're talking about current events today and whether they should affect your decision to retire or not. If the headlines lately have you wondering whether it's really the right time to retire, that's not a sign to wait. It's a time to get a plan. And Jeff Vogan and the team here at Premier Retirement Planning are offering a complimentary Premier Retirement Roadmap to help you see exactly where you stand. Do you have enough protected income? Can your plan handle inflation and market volatility? Well, you can find out now by calling 520-780-9059 or visiting premret.com. It's 520-780-9059. Don't guess about retirement. Get a roadmap. Entirely no cost and no obligation. Once again, that phone number, 520-780-9059, and you can make that call right now. So back to our conversation, Jeff, let's get practical. Should someone really delay retirement because of everything going on in the world right now? And I'm talking about the war in Iran. I'm talking about gasoline prices, oil prices. I'm talking about inflation not under control. Are these signs that maybe it's better if you wait until this is all over to retire?
Well, I think I'll just double down on my last answer, and that is if you have a plan, it doesn't matter. Sometimes the market wants you to think, well, it's just about long-term averages. That's all that matters. It's not. It's really about timing. And it isn't timing every investment. It's basically, what if you retire, like the story I tell so often about Norm? I'm sure everybody listening has heard it by now. Retired a very well-off millionaire back in the year 2000. Y2K, he was in the microchip development business, a big chip company up in Phoenix, and said, I got $1 million. I'm 60 years old. I'm going to give myself an early retirement. My broker says 10% is the average market return over time, and that average should be fine. I should still be able to get my $100,000 and never run out of money. In fact, never even draw down my $1 million. Well, what happened in 2000, 2001, and 2 anyway, 2003, it started coming back. But bottom line, it dropped right out of the gate. So his retirement timing was horrible because it was right before a market crash and he had everything at risk. If he were smarter, he would have taken his $1 million out of risk, set it up to where it would guarantee him enough income to live on, and maybe risk a third of it or a quarter of it or even half of it, depending on what he really needed to live on during that period of time. Poor Norm had to go get a job, had to take Social Security early, and came to me in 2009, almost out of money again after a second market drop, wondering how am I ever going to get through retirement? I'm only 70 years old. I'm healthy, and I've been working for the last 10 years instead of retiring. What's going on? I can't do this. You need to help me out. I said, I can't help you out. You broke your plan because the market timing hurt you because you didn't have a plan before you retired. You didn't have a plan of protection. You didn't have a plan of income. So there's the sequence of returns really matters. Now, if he would have waited 3 years and all his money was still in the tech stocks, guess what? He would have still been down. He'd probably been scared of retirement. He would have probably still ended up working 10 years and probably been 70 before he could finally get out of it. But at least he would have had a paycheck and his $1 million would have been back. Actually, it took 14 years for the high-tech company stocks to get back to where they were and then some. So it could be very likely that Norm would have still been working even if he did come see me at 2009. He'd still been trying to make it back. But again, he would have been still dollar cost averaging into the market, hopefully saving his 401k and having a paycheck instead of drawing it down and having a much higher Social Security paycheck. So yeah, if you're going to have everything at risk, you might want to work an extra 10 years just to be sure. It limits the decades that you have to retire and pay your way. It increases the amount you can continue to put away. It helps you weather what storms might be ahead. Again, that's if you have everything at risk. Now, that doesn't, just saying it, does not sound like a very compelling argument to not retire or to keep assets at risk. In fact, it's the opposite. Shouldn't that be a compelling argument that if the market's at all-time highs, if the market's at all-time high price earnings ratios, overvalued at all-time highs, not just all-time highs is fine if the valuation is reasonable, but we've so overbought the market that it's at historical levels. Only once or twice has it been this bad as far as just how much we're willing to pay for a share of stock in a company that may or may not even have earnings. And that's typically right before it drops. People say, oh, it keeps making new highs. We've had, 56 new highs in the Dow this year. Well, guess what? Past week, it's also at its year-to-date low. So what does that matter? It doesn't mean anything. Every market crash has come after an all-time high. Think about that. Like, oh, it's an all-time high. It's an all-time high. Well, all-time highs don't mean it's going up. It means it went up. Doesn't mean it's going. It doesn't mean anything. So the silent retirement killer, so to speak, is basically market risk and not handling it correctly and being subject to the whims of the market or other things that you can't control. So if you're over dependent on the market performance and you don't have at least a 2 or 3 or 4 or 5 year income buffer, I think you're foolish. And I think your plan will only work in a good market and won't work in a bad market. I know we're going to have a bad market because we always end up having them. They just are a part of market cycles. I don't know when it's going to happen. I'm taking advantage of watching where rich people's money's going. I mean, smart money's people's going, like Buffett and Dalio and those guys that manage $1 trillion or more. These people are pretty insightful in the market. They have more information. I mean, they can buy more information than I could ever buy. I buy a lot of stuff and now you have a lot of insight. But a lot of what I do is follow the money and follow the smart people. And if they're raising cash, they know that we are coming closer and closer to that day of that market correction because they are the smart money. Now, they've been raising cash for a couple of years now. Does that mean they're late or they're stupid? No, they know it's coming. The thing is when you've got trillions of dollars in play, you can't get out of the market in a day or a week. It may take years. For us as smaller investors, we can decide to get out of the market Monday, be totally out by Thursday if we want, or even by Tuesday or Wednesday, because it's easier to move millions and tens of millions, even $100 million than it is billions and trillions. So again, we can still watch the market and be fairly nimble, but that doesn't mean you should always have your money at play, because I know that sometime, and all the smart money knows that sometime, probably in the near term, as far as, a few years or a few months, we're probably going to have that big correction that we're overdue for. Are you prepared? Well, the way we get prepared is make sure that you have enough money in principal protected accounts that aren't going to go down and you can live on. But if you've got everything in the market and all you have is a 2-year income buffer, let's say you need $100,000 to live and you've got a couple $1 million in the market. So let's say you have $300,000 in cash that you're going to use in case the market falls. So you've got, let's say you have 1.7 left in the market and the market crashes by half. Now you've only got roughly $800,000, $850,000 because the market corrects 50% like it did twice in the 2000 to 2010 decade. And we could very easily be due for a correction that big because we have an abundance of margin buying, meaning people are borrowing against their stock. If there's a sell-off, that'll exacerbate the sell-off. If we look at what fair market value is compared to historical averages, the S&P should be about half of where it is. The Dow should be about half of where it is. NASDAQ, same. So let's say we have a 50% market correction. We get finally down to where people can be sane about the valuations or historical valuations that we're willing to pay. And by the way, people say, yeah, but it's different this time. It's different this time. People have said that on every market correct, and it's never really different. So until it really comes out different, I'm going to just believe that could be the possibility. Well, if you've got $850,000, it's got to recover by 100% before you actually can start dipping into that. So let's say, does the market go up 100% in 2 or 3 years? No, it never has. I mean, in order for the 50% corrections in 2000 and 2008 to get back to even, those recoveries on the S&P and Dow were about 7 years each. So basically, if you're using $100,000 a year to live on, you're locking in losses on the next 3 or 4 years of your money. And if you do recover, instead of getting back to the 1.7 you thought you'd have, maybe you're only back up to 1.2 or so. Well, how's that going to go for the next couple of decades? Because you only had a 2 or 3 year buffer. How about having a 20 or 30 year buffer that provides all the income you need to get through any time, hard times, good times, bad times? Use your investment money for what we call play checks, or the fun money, or for the, I don't really need it, but if the market's good, I can do fun stuff. If the market's bad, I still pay all my bills and I can still do fun stuff. I just don't get to ride first class. I go coach, whatever, but you can still do stuff. I mean, okay, you need a new car. Well, maybe you buy a Toyota instead of the Lexus version of it because the market's bad, but market's good. Man, go buy that Mercedes, go buy the Bentley, whatever. As long as you've got income that pays all the bills, and if you're used to living on $100,000 and you've got some income increases built into your plan, you should be okay. Unless inflation goes crazy, then everybody's kind of resetting on a percentage basis except the ultra rich. So again, it's all relative. Life is not different this time. Life is the same as it's been before. We've been through things like we've been going through right now. Nothing is new. Everything is a repeat performance if you look at it, if you look at history. And guess what? Over time, everything works out. Everything becomes okay. But there's periods where it's not okay. You just need to be prepared for those times where it's not okay.
Jeff, final thought here. What do you think retirees should really take away from our conversation this morning?
Well, the wrong question probably is, should I retire because of what's happening in the world? The right question would be, am I prepared for whatever happens in the world? Because if I retire now, I've probably got 20 or 30 years to go. And what's happening right now is only going to be a temporary piece of that puzzle, and it's not going to be forever. But is your plan strong enough to handle all the uncertainties, not just the ones that we're dealing with right now, but the uncertainties that are continue to repeat throughout the remaining of your retirement life? What are your goals? There's always going to be something that's happening globally. Are you prepared for it? Do you have principal protection on enough money to provide you income? Are you paying too much in taxes? Is it a tax efficient plan where maybe you're making $200,000 a year, but only paying tax on $100,000 a year? That means you've done some really good tax preparation, either maybe through some Roth conversions, some LERP planning, some charitable gifting, some different things that you might do that reduce your taxable income, but keep your spendable income even higher because of the taxes you save. So we got to create income, make sure the investments correlate with that. And if you've got income and the secure money secure and your principal protected on enough of your money, then you could even be more aggressive on that segment that you put into the market. And that's where real returns can be made. Instead of basically not getting returns on half your money because you want to be conservative, put it in principal protected accounts where you're guaranteed to have some upside and no downside. And then you could be a little bit more aggressive on less of your money and probably beat what you would have done if everything were all at risk in the market. And that's what we're looking at, is the overall returns based on risk is a lot lower risk and higher returns is what we're seeking. And if you've got a plan that reduces risk, increases returns, provides more peace of mind because the income is secure, saves you some taxes, makes sure that if something happens, heaven forbid you go to a long-term care facility or assisted living, that you're covered there, that you have resources to handle that without depriving your spouse, a healthy spouse, a decent retirement during that time. You shouldn't both have to suffer or decline together financially. Plan for it. It probably is not going to happen at the same time. And then what happens when you pass away? Does your money disappear? Or does it get caught up in probate? Or does it go to who you want, how you want, with the least amount of trouble, taxes, and frustration to your heirs? Those are basically the 5 pillars of planning that we deal with. And that's really what the question should be, is how do I take advantage of all of that, making sure that I have a comprehensive enough plan that I have confidence in retirement.
A good retirement plan is built to survive reality, not ideal conditions. So if the headlines have you wondering lately whether or not it's the right time to retire, that's not a sign to wait. It is a time to get a plan. And Jeff Vogan here and the team at Premier Retirement are offering a complimentary Premier Retirement Roadmap to help you see exactly where you stand. Do you have enough protected income? Can your plan handle inflation and market volatility? Well, you can find out right now by calling 520-780-9059 or visiting Premier premret.com. Once again, it's 520-780-9059. You can make that call right now if you want. Leave your name, telephone number. Shelley will call you back during the week and set up that appointment for you. Again, it's just a casual conversation between you and Jeff to answer your questions and put you on a path towards a confident retirement. So don't guess about retirement. Get a roadmap, get a plan. 520-780-9059. You can make that call right now. Jeff, time for a break. When we come back here on Premier Retirement, we've got listener questions and more when our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shade.
Thanks so much for joining us here. You're listening to Premier Retirement with Jeff Vogan. My name's Jeff Shade, and we're here for you each and every week for your fiscal fitness and your financial education here on 790 KNST. We're on the air for you 4 times a week, Saturdays at 7 a.m., 9 a.m., and 1 p.m., and then on Sundays at 11 a.m. And if those times are not convenient for you, of course, you can always hear us on our podcast 24 hours a day, 7 days a week, 365 days a year. Go to wherever you get your podcast, search for Premier Retirement with Jeff Vogan. You'll find this show and many, many hundreds of our past shows so you can stay on top of your journey towards a confident retirement. Once again, our phone number 520-780-9059. If you hear anything in the program today that piques your interest, you can call that number right now and set yourself up with a casual conversation with Jeff. No cost, no obligation. We call it the Premier Retirement Roadmap, and again, it is entirely yours at no obligation. 520-780-9059. You can find out more about us online at premret.com. Okay, Jeff, time for listener questions. We'll start it off this week with Greg, listening to us in El Encanto, and Greg says, I'm 62 and planning to retire this summer, but the market makes me nervous. Should I delay retirement? Sort of plays into our last segment.
Yeah, bottom line is it just depends. Here's the deal with retiring right now is we're at the height of the market. And if you're going to take profits off the table, you cannot lose. You're going to take money out of the market when it's near its all-time high. And you can't really ask for more than that. Could the market go up? Yeah. And if you move it to principal protected assets that still go up when the market goes up, you're going to still make money. But if the market crashes, you can take that off the table, create a sense of security and confidence that shouldn't make you nervous. I think the only thing that should make you nervous, and you should be nervous, by the way, with all the stuff that's happening, if you got everything at risk, if you got everything in a 401k or in a pension plan that is all market-based, you should be nervous. And I think anybody should be nervous. And I can't imagine how stressful retirement would be if you had to rely on something you cannot control. You had no guaranteed income. You never knew when the market was going to crash, but you needed a monthly paycheck. And I'm guessing at 62, if you're planning to retire, you probably made a decent amount of money. You may or may not need your Social Security right away. But if you don't plan to go back to work, it might be worth taking Social Security and allowing some of these other assets that provide income to grow. And I'll just give you an example of some of the things that we use at your age. If you had some of your assets, let's say for every $1 million, I don't know what you have, but if you're retiring at 62, I hope it's in the millions because you've got a long haul left or you have a good pension or whatever. Well, let's just say you create your own pension. Let's just say you have $1 million like Norm did, could be 3 or 4 million, whatever. And you take half of it and you put it into an asset that gives you a 30% bonus towards income if you use it for income. Now, these insurance companies that offer pensions, basically personal pensions, are insured, secured, and they keep your money safe. They take all the risk off your shoulders. They invest the interest that they make into market-related options and things so that if the market goes up, they make maybe double or triple the interest that they're making on your money. They take maybe 1% and they give you the rest. So you can make double-digit returns on those. The cool thing is all they're risking is the interest that they make on your money. And so they can guarantee that over time, they're going to make money. They know what the actuarial numbers are. They have a pretty good plan. Now, they might not make it every year, but they know that over time, they'll make X. And so they'll be able to give you an annuity that pays you X guaranteed income. They're pretty sure they're not going to run out of money in your account. And that's how they base these income payouts. But if for some reason they're wrong, they still pay you the income. And let's say $500,000 of the million goes into one of these accounts, and 2-3 years down the road, after you've spent a little bit of savings or waited a little bit, you could grow some of these accounts, 30% bonus and up to 9 or sometimes 10% per year. And then you get income based on the future value. So in just a few years, that 500,000 could actually have an income value of $1 million. What would that $1 million pay? I don't know, probably somewhere around probably $50,000, $50,000 a year. if you wait a few years before you take it. So if that's what you need plus Social Security to make ends meet, that certainly beats a 4% rule on $1 million, which says don't take more than $40,000 out a year, you probably go broke. Well, what if you could put half your money away into something that would give you a guarantee of at least $40,000 a year, and then still have half of your money growing and not needed on a month-to-month basis, so that over the long haul, you could make more money because you didn't need to tap it for an income stream every month or every year. So use that, add a zero, add a few zeros, add some numbers to make it your actual situation. But those are just round numbers that help you understand the philosophy. Now, the other thing you could do is create some tax-free income by redeploying some of your money into Roth IRAs or even a LERP. You could even do one of these indexed products, insured products that give you income, and you can make that income tax-free as well. So depending how aggressive you want to be right out of the gate, you might want to pay some taxes on some of that money and convert IRA money, for example, instead of to a future tax problem, into a future tax-free blessing by just basically divorcing the IRS now. In other words, paying taxes on it early and never paying taxes on it again might be better than paying taxes for the rest of your life on an ever-growing asset base. So again, tax planning, asset preservation, utilizing the tools that are available to you outside of your 401k, because most people who are 62, honestly, that I meet are very unfamiliar with anything outside of stocks and bonds and a 401k. So explore the rest of the world. There's all kinds of retirement-focused products that have come about because the baby boomers are booming and they are retiring right now. And it's a huge market, and there are needs there that Wall Street cannot support or take care of. And other institutions, other asset classes can be used, alternative assets, sometimes even private equity, sometimes insurance products, can make life a lot simpler in the long run, but it might seem more complicated because you have to learn about a couple of new things. No big deal. We know about those new things. We can help put it together in a comprehensive plan that makes it a lot more easy and understandable to see how the pieces of the puzzle fit all together. But the bottom line is you just need a plan. You can retire right now. Or if you don't know if you can retire, come in and we'll build a plan that says, hey, this is your guaranteed income. That's reasonable if you use these assets. And this is your maybe income if you leave it where it is. And maybe you'll decide, well, maybe I need to work a few more years. I think I'd be more comfortable to get to Medicare age because I don't want to have to fork out huge money for insurance for 3 more years or whatever. I mean, there might be some things that we can alert you to because we've helped people basically get on this retirement boat and plan for it. And sometimes they come in and find out that they're a little bit short of where they want to be, or sometimes they're so far ahead that they wish they'd have retired at 55 instead of 62. So bottom line is we can get you some clarity, show you for what works for more than 30 years of, and thousands of people over those years that have retired and have not had to unretire. They have stayed retired. They've been able to make ends meet, save taxes, pay their bills, and not wake up worried every day.
Greg, thanks for listening to us in El Encanto. And again, if you want a clear picture of your retirement plan in today's market, call us here at Premier Retirement, 520-780-9059, and request your Premier Retirement Roadmap with Jeff. Again, it's not going to cost you a dime, 520-780-9059. Next question, Jeff, is Daniel hearing us in Ventana Canyon. And Daniel says, we split time between Tucson and the Midwest, specifically Chicago. What should we consider financially if we were to go full-time here?
Well, financially, you'd be making a good decision moving here. I love visiting Chicago. I think there's some awesome places there. I don't know that I could handle living there just from, I don't know, what I hear on the news, if it's even half true. I don't want to live there. So good for you for moving here to Arizona. Not that the world is a great place everywhere, but the weather's fine. You're not going to have to dig yourself out of an icy driveway here. You can always go to the mountains in a couple hours and get cool if you need to in the summertime. You don't have to fly back to Chicago. You'd only have to support one house maybe, and that might be a financial benefit as well. So, until I see the whole picture, it's probably hard for me to gauge your whole situation. But healthcare access and costs, I think they're pretty good for retirees here. I mean, our whole state is pretty much built on the retirement economy. And I think your state taxes will probably be less here. I don't know what they are in Chicago, but I believe they're a lot higher. Housing, insurance, I mean, those are all those things that I think you'll find better. Healthcare, taxes, housing costs, not having to hire the snowblower to dig you out of your driveway in the winter. Your spending patterns might change a little bit because you might find out that there's more fun places to go. You might travel a little bit more, but you probably already planned that into your plan. So we can run a side-by-side retirement scenario comparison when we do our retirement plan. We put it on a spreadsheet and we go plan 1, plan 2. It says, hey, this is if you keep both houses and probably what the cash drain and requirements would be. And this is how much extra fun and extra money you'll have if you just pick one and stay here. So again, just look at the situation. The math will help you decide because math and numbers are something we can count on. They're not whimsical of a market or politics or anything else. Numbers are numbers, and they will give you a better picture of what you can expect if you go full-time here as opposed to try to split the difference.
So it's not only a lifestyle consideration. Of course, we've got sun versus snow. Population here is a fraction of what it is in Chicago, but also there are financial considerations too. Living in the state of Illinois and particularly in Chicago can be significantly more expensive than it can be here in the greater Tucson area. But again, it's going to come down to having a side-by-side comparison. And of course, we would love to do that for you here at Premier Retirement. Daniel, thanks for listening to us in Ventana Canyon. And come on in and we'll help you make the right decision. Next question is Paul in Dove Mountain. And Paul says, I'm 64 and plan to retire in 3 years. I have about $500,000 in a 401k, $1.5 million in the market, and $250,000 just sitting in cash equivalents. How much of my portfolio should be income versus growth?
Well, let's first of all determine what you mean by income and growth. Growth, obviously, that's stocks, things that have upside potential, also a lot of downside potential, basically all risk, and the money that you don't want to use for income, obviously. And that's why you're asking the question. I appreciate that. But income, sometimes they call fixed income securities or fixed income accounts are something with a dividend or something with an interest rate of 4 or 5%. But if we look at the bond market, the 20-year bond has gone down 30 or 40% in the last few years, and it's still down. So if you're actually considering that an income portfolio, you, I hope, are only expecting to use the 3 or 4% interest, not more. There are better dividend paying stocks, in my opinion, a lot of them in the energy field. But be careful that just because it has a high dividend doesn't mean it's a great stock. I remember AT&T is a popular one that has always paid a dividend, but up until recently, for the last 5 or 10 years, it lost more than the dividend. So if you ever needed to cash that in or take profits, did you really make any money? No, you basically got all your profits and spent them as you go. So be careful on how you judge income. I don't think income should be used at any security. I don't think bonds are an income play. I don't think dividend stocks are an income play. They're sort of an income play just because they tend to be a little bit less volatile most of the time. That doesn't mean they're less volatile all the time because dividend stocks can be hammered too. Look at any dividend ETF and you'll see that the market on dividend stocks is very correlated to the market on growth stocks and everything else. So be careful with how you let Wall Street tweak your mind into believing that somehow if you just have a certain allocation in bonds, you're fine because that's your income account. Bonds can go down too. And if you're taking money out of an account that's down, you're locking in losses because you're not just taking the income off of that. With $2.5 million roughly, or $2.25 million in total assets, and I don't know if they're all IRA or non-IRA assets, that would be another helpful bit of knowledge to help me steer you in the right direction here. But bottom line is, if you use the 4% rule, you're living on maybe $80,000 a year, maybe, right? And that includes taking principal plus interest out as you go to not run out of money. Now, if we're retiring at a low point in the market and you had $2.25 million, I'd say that the 4% rule is probably a little weak. But given the fact that the market's at an all-time high and record historically overvalued valuations, I would say that that 4% rule is probably not going to play out very well in the market and in the stock and bond market. So income accounts should be income products that were built for income. Insurance companies manage pensions. They also manage personal pensions. I talk about annuities, fixed index annuities that give income riders that guarantee growth in good markets and guaranteed principal protection in bad markets. These companies and companies that you've heard of, good companies, A+ rated companies, very strong companies, offer, and we have access to some proprietary products because of certain groups, that big producing groups that I belong in as independent advisors. We can actually have products built for us that are pretty compelling, and I think you'll probably like because you can't get them on the off the shelf at any big broker, big insurance company. But they might give you bonuses. And just to give you a perspective, a $2.25 million, $80,000 would probably be a reasonably good income for you to get through retirement. Well, I'd imagine if you have 2.25, you're probably used to making a couple $100,000 a year by now. If you're 64, that's probably in range with a $200,000 or better income. You probably want to keep living on that kind of an income. So 80,000 isn't going to cut it. What if you could get maybe 50 or 60 between you and your wife on Social Security, and with 2/3 of that money, set it up between LIRPs, life insurance versions of tax-free income annuities, and index annuity that would be, it may be taxable if it comes from 401k or IRA money, but create a levelized income of probably $120,000, $130,000. So that plus Social Security might get you back to that $2 million, and you'd still have $500,000 or $600,000 or $700,000, maybe even more of assets that you could keep in the market, keep in growth, and keep really aggressive. But I think your income play needs to be fixed, guaranteed income, not just what if income because Wall Street says this is income, because it isn't, especially if you're thinking about the bond market or dividend stocks. It isn't. They're not safe. They are not principal protected. Get your income from principal protected accounts, period. That's what makes sense. I'm independent, so I can use both of those asset classes. If I worked for a brokerage firm, and that's the reason I left, is they require you to only sell what they want you to sell. They don't like insurance companies because it creates an income stream, and they don't pay fees every year. Sometimes they'll pay you one time up front, or they'll pay you an ongoing fee, but it's less than what you make by turning and burning in the market. That's just the facts. And they say, oh my gosh, they have commissions. Well, yeah, but they don't have ongoing fees and back-end charges and spreads and all the things that Wall Street makes. They're just trying to talk you out of doing something that doesn't benefit them. So if you want to benefit you, use all the tools out there, explore them if you haven't. But I think you could probably still live on that income. You could probably still easily live on a couple $100,000 by putting maybe half to 2/3 of it in income and being aggressive on the part that's not. So that would be my take on that just in first glance. But of course, we want to dig in and make sure how much of this money is in 401k, IRA, Roth IRA, and how much is non-qualified, and how much interest and dividends are you paying taxes on every year, whether you're using it or not, because you might want to rotate out of those things that give an uncertain 1099 and tax bill every year to something that's a little bit more streamlined, it's more rigid, it's more predictable, and you can see what your future taxes are going to be rather than just guess at them.
Paul, thanks for listening to us in Dove Mountain. And again, if you'd like to talk to Jeff, 520-780-9059 is the number to have that one-on-one casual conversation. 520-780-9059, no cost and no obligation. If you're within 5 to 10 years of retirement or you're already retired, this is not the time to be guessing. The world has changed and your retirement plan needs to reflect that. Jeff Vogan and the team here at Premier Retirement are offering a complimentary Premier Retirement Roadmap, a personalized plan that shows you exactly where you stand. Do you have enough protected income? Can your plan handle inflation, market downturns, and the unexpected? Well, you can find out now while you still have the time to make adjustments. Again, that number 520-780-9059 or visit premret.com. Don't leave your retirement to chance. Get your roadmap today by calling 520-780-9059. Jeff, let's talk about the number one mistake that forces people to unretire. We hear all the time about people retiring and then a couple of years later, they're back working. What do you think is really going on there?
Well, the times that I've seen that really hit hard is times of big market corrections where people go in a little half-baked and a little complacent about the market because it's been good right up until retirement and then have a big market correction. Lately, I've been seeing that because just the economy is getting a little hard. Inflation's a real factor. The basics are getting more expensive, even though maybe some of the discretionary items may not be. But overall, people are kind of misunderstanding what I think their actual lifestyle is. Case in point, I just talked to somebody that was making probably take home probably 140, 150. I says, well, I'm going to retire, but I only need like 60,000. I can live easy on 5,000 a month. I'm like, well, you're not right now. He goes, well, yeah, I really am because my house is this and I've already done my budget. I'm thinking, okay, well then how much did you put into savings last year? Because if you can live on 60,000 a year, you should have put $80,000 in savings. Well, no, I'd say probably 20. Okay, then you're actually spending 120, not 60. So sometimes people get an unrealistic picture just because the fixed expenses are X. Lifestyle expenses, I mean, people do stuff other than just pay a mortgage and gas for their car and buy food. There's other stuff going on, not to mention the insurance deductibles, the trips that you take, the new car you want to buy every once in a while, new furniture, maybe fixed air conditioner, just all these different things that add up to lifestyle expenses that are not fixed expenses. So I think people kind of underestimate those sometimes and might find out that they have to go back to work. Now, there's two definitions I have of retirement. Well, actually, retirement is just, I can't work anymore, so I have to not work, or I just want to not to have that job anymore. And then the unretire, I think, is only applicable to people that have to go back to work, because I know people that go home and find out that they just can't stand the sit around. They have to have something that keeps their mind active and they want to go back to work. Sometimes a doctor, an engineer, or somebody that has some pretty intense careers think they want out, but then all of a sudden their mind starts slowing down. They go, gosh, I got to go back and do something. Maybe they go back into consulting or a part-time deal, or even school teachers. Maybe they go and just help out a couple of days a week at the school to just be around the things that used to make them happy, but they don't have to feel like they're forced into it anymore. So if you go back to work because you want to, not because you have to, I don't consider that unretiring. And people are doing that just for mental sanity or for health conditions, because I do believe that the people that live the longest are the people that stay active and keep their mind active. And that might include doing something that requires a little brain power and working job on the job type stuff. Maybe not manual labor like a construction worker framing houses. I mean, you probably don't want to be doing that when you're 70, but consulting or checking out things that keep your mind active and keep you from getting Alzheimer's and things like that when your mind kind of goes still and kind of fades. So again, I don't think it's bad to go back to work, but it's bad if you have to go back to work and you're not doing it on your terms. And if you're groveling for a job and you need a paycheck, and the paychecks that you probably want or are used to making, if you have to unretire, are not going to be the paychecks you used to make. They're probably going to be a part-time thing. People know you're desperate. You're not going to get the best paying jobs typically, unless you're C-level person is somebody who needs you back because their business is failing and you might be able to squeeze back in someplace. But even then, most boards have age limits and you might not even get those really high paying jobs and those really important jobs back if you did want to. And why would you want to if you've already retired from that? You're probably doing fine on a pension and you've probably saved if you were smart enough to do so. Again, it's all relative, but if you have to go back to work, the only reason I can see that happening is you didn't have very good clarity on what your spending habits are, your lifestyle needs are, or you just didn't do a plan. Either way, you need to go back to the drawing board and fix it. And we do fix people that are midstream very often and redirect them and kind of regroup and have kind of that reset. And if you need a reset, we're here. If you want to know if you can retire, we'll give you a good income plan that is tax efficient and shows you where the guarantees are. And then you either need to see if that's going to work or see if that really fits your retirement budget and wishes. And if it doesn't, then keep working for a few more years. But I'd rather you work a few more years and then retire than retire and then find out you have to unretire and go back to work for a few more years, because that would probably take you longer to do it if it's a second round than it is if you just work a couple more years and get a stronger footing and foundation under you before you retire in the first place.
So, Jeff, let's come back full circle. How do you fix this problem of needing to go back to work before it becomes a real problem?
Well, I mean, you need to remember the retirement paycheck is more important than the retirement growth or risk strategy. We call them paychecks and playchecks. They're different. Playchecks are those things that we might be able to risk a little bit, but paychecks are those things that pay the bills, that support you through what your needs are, basic needs, plus a little bit of lifestyle needs, depending on how much safe or guaranteed income you have. It would depend on what percentage of your assets you want to put in an income, safe or predictable type of an asset. Growth is more long-term, market-based. It's something you can't control. And so you should be mindful of that and only have assets in the market you can afford to lose or wait on. So again, that's our philosophy. Lou Dobbs said it right after the market crash in 2000. We talked about Norm earlier. You know, the AARP did an article and says, what about guys like Norm? They didn't say Norm, but guys like him who lost a bunch in the market. He says, well, I've always said, but nobody listened. You shouldn't have money in the market you can't afford to lose, period. And that's true, even though over the long haul, it provides some good results. Don't have all your eggs in one basket. Some people say, well, I have 100 different stocks and I have different ETFs. I'm so diversified. Well, if you're diversified in 100 different things that go down when the market crashes, you're not really diversified. You have all risk, and that's not diversification. You need to create multiple income streams, whether you have a pension, whether you have Social Security, that's good. You know, when do you take Social Security? The timing of that makes a difference. What about portfolio income? Does it spin off enough dividends and interest where you don't have to eat the principal? And do those assets hold their value, or do they decline as you get paid out? You know, that's a bad income portfolio. My position is an income portfolio should give you guaranteed income, and you should expect that portion. Expect to spend down your principal plus interest. Get guarantees, knowing how long it's going to last, regardless of whether it performs well or not. It's going to be insured, secured, and that income is going to be stuff you can count on. And then there might be other structured income sources. There's some private equity that pay monthly dividends or interest. Sometimes they're a little riskier than others. They're sometimes a little bit less liquid than some. But if you're using that for income, why do you want it to be liquid? I mean, you can't cash out your Social Security trust fund either, but it's guaranteed to pay as long as you live. But then guess what? The balance of it just stays in the trust fund for other people that outlive you. What about setting yourself up in some of these income streams that pay you as long as you live, but the balance goes to your heirs, your spouse or your loved ones? The goal is basically cover all your essential expenses plus a little bit of buffer with reliable, guaranteed income to help you sleep at night and have confidence throughout your retirement. Retire on your terms can only happen if your bills are paid and you're not waking up worried and scared every day. And then growth money, be able to let it ride without panic. We move money around when the markets change. We look at it every day. I mean, I invest my own money the same way as I invest my clients' money. It's the same portfolios. You know, if I buy Apple stock, my clients buy Apple stock. If they want risk, I mean, we can be on the same ride. So I'm watching it every day. It's not like I'm just say, well, just park it in the QQQs or the SPY or just get an index and hold it forever. Well, that's passive management. You shouldn't have an advisor. You shouldn't need an advisor. You can do that yourself. But then again, you have all the risk and nobody navigating the river or the lake or they're not navigating your retirement boat. They're not driving it for you. You're on your own. And if it's your first retirement plan, good luck. If it's our 10,000th retirement plan, I don't even know where we're at now, but we've done a lot of plans. We've done this. We've sailed these waters before. And you should be happy to have somebody like us steer your boat, whether it's us or somebody else that you feel confident in. Basically, you shouldn't have panic or stress in retirement. Retire on your terms. It should be an enjoyable time, not a stressful time.
Great conversation, Jeff. If you're within 5 years of retirement or you're already retired, this is a topic that's too important to ignore. If you want a clear picture of how your retirement plan is going to turn out for you, you want to avoid uncertainty, then call Jeff Vogan here at Premier Retirement and sit down and have that one-on-one conversation at no cost and no obligation. The number to call, 520-780-9059. It's 520-780-9059. You can also find out more about us online at primret.com. Don't guess your way into retirement. Build a plan, get retired, and stay retired. Jeff, out of time for this week. I want to thank you for your time, but most importantly, as I do every week, I want to thank our great listeners for joining us here in the greater Tucson area. So for Jeff Vogan, I'm Jeff Shade, wishing you a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. This show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.